As much as we want it, money doesn't grow on trees, and that extra cash always has to be prioritized in order to make sound investment decisions. Most potential pitfalls of a poor investment choice are not crossing your mind now, but believe me, those thoughts will appear once things start to tremble a little. The average person does not cross their fingers and risk $10,000 all at once. Saying consumers shouldn't strive to outperform the market by selecting profitable companies is both unhelpful and condescending. So let's look at the smartest investment decisions to prioritize your hard-earned savings. Number 1. Emergency fund. It aids in relaxing your mind and body to help you feel better. It's not shocking that worrying about money and feeling overwhelmed come hand in hand with a life emergency. You are living on the financial edge if you don't have a safety net and are just hoping you can avoid a financial disaster. When you're prepared financially for any eventuality, you can handle it with grace and dignity. Avoiding frivolous purchases is one of the main benefits. The adage, out of sight, out of mind, is well known. In case of an emergency, that's the finest approach to save cash. It's not really an emergency if you have access to a large sum of money with the swipe of a debit card. You won't be able to spend the money on a whim no matter how much you want to if you don't have access to it. You can better keep track of your savings and determine how much more you need to put away if you open a dedicated account for it. It prevents you from making rash choices with your money. Sure, you could borrow money rapidly, but at what price? Interest, fines, and penalties are a few of the issues. Number 2. Plan accordingly. If your finances are in disarray, even a $10 investment may seem like too much of a reach. Think about the following before deciding how much to put away. Money coming in. Think about the amount of money you have each month after you pay your bills and fixed expenses. If you're having difficulties making ends meet, save or pay down your debt with whatever spare cash you have. Amounts owed by you. Without a method to eliminate it, debt, particularly when coupled with high interest rates, may be stressful. Evaluate your debt and the associated interest rates. Money set aside for emergencies. According to the most recent statistics from the Consumer Financial Protection Bureau, 24% of consumers have no emergency savings, and 39% have less than a month's salary saved for emergencies. Determine how much of your disposable income can be invested, while still allowing you to meet your minimum payment obligations. You may evaluate your monthly investment amount as you reduce your debt and determine whether or not to raise it. You need a rainy day fund if you want to avoid taking out a loan to cover unforeseen expenses. You may choose to invest less of your income if you have yet to save enough money to cover 3 to 6 months of living costs. Number 3. Choose a strategy that fits you. Create a strategy and see if it can function autonomously. Creating a simple strategy or automating the process might help you achieve your financial objectives more quickly. Do your best always to save a portion of your earnings. Be consistent in your allocation of funds. Direct deposit allows you to automatically move money from your salary or checking account into your savings account on a regular basis, which is something to consider. To remember about saving, set up automatic transfers. You're less likely to be tempted to squander your funds if you can't easily access them. The savings you make pile up over time, so even a modest beginning can be beneficial. Also, instead of setting aside $150 per month, consider setting aside $5 every day. They both add up to $30 after a month, but saving $5 a day is 4 times more likely to motivate individuals to start saving. Number 4. Where do you want to put your money? Prioritize your objectives. Think about the pros and cons of each option and what you'd be giving up if you made a certain choice. Worried that you won't be able to save enough for retirement and your child's college? You can get a loan to cover the cost of college tuition, but you can't do the same for your retirement. So put some money aside. Thus, you could have to decide between investing in your own retirement and financing your children's further education. You should contribute to your employer's retirement account if having a secure financial future in retirement is a priority for you. Employer matching programs are a great way to boost your savings immediately and, thanks to the power of compound interest, potentially increase your return over time. After that, consider paying off high-interest debts, especially those with rates above 10%, before contributing more than your employer's match. This is because, depending on the state of the market, the interest you'd paid on such debts could exceed the returns you're getting on other investments. Number 5. A Roth 401k. The Roth 401k is an alternative to the regular 401k retirement savings plan, but there is a major distinction. Contributions to a Roth 401k are made after federal income tax has been deducted. Thus, your contributions to a Roth 401k account are not taxed throughout their growth or when you withdraw them in retirement. In 2006, the Roth 401k was established, which merged the advantages of the standard 401k with the Roth IRA. A Roth 401k allows you to take advantage of your employer's matching contribution policy if it exists, just like a standard 401k. Also, the Roth feature of a 401k allows you to withdraw funds tax-free in the future. In what ways are Roth 401ks different from traditional 401ks? The primary difference between a Roth 401k and a standard 401k is how your contributions are taxed. After-tax contributions to a 401k plan are called 401ks. Therefore, the funds you deposit into your Roth IRA have already been subjected to taxation. On the other hand, a regular 401k allows you to put away funds before they are taxed. Funds contributed to a standard 401k plan are deferred until retirement, at which point they are invested and protected from taxation. If this is the case, you will have less money to pay taxes on. The maximum annual contribution to a Roth IRA is currently $6,500 in 2023, or $7,500 if you are 50 or older. However, there are no earnings caps on contributions to a Roth IRA, so you may put away as much as you choose. The term Roth conversion ladder refers to gradually transferring funds from tax-deferred retirement accounts into a Roth IRA. Since inflation is now at its greatest level in 40 years, it might be a good time to consider utilizing this ladder to one day remove funds without incurring taxes. Number 6. Open a brokerage account. Using an online brokerage account is one of the most convenient methods to invest in stocks. You can hire a professional for a modest charge to manage your portfolio if you don't feel comfortable doing it yourself. It doesn't matter how much cash you have, you can invest it wisely on the stock market online. There is also a more conservative option, investment in commodities. Real estate, equities, derivatives, and currencies are all viable options for a hedge fund. As opposed to an individual investor, a mutual fund must invest for the long term, and may only do so in stocks or bonds. Investment in a hedge fund is open to anybody who satisfies the minimum conditions. One of these standards is a current annual income or net worth of $200,000. Once again, the majority of hedge fund investors are quite well off. How do you prioritize your money? Tell us in the comments, leave a like, and subscribe for more videos like this.